Hi, this is Chris from StockSpot. Now, one of the biggest financial decisions you'll have to make is deciding what to do with your extra savings over your life. Should you put it into super? Should you put it into an investment property or some sort of other investment? And this is a question we often get from our clients. So in this video, I'm going to be talking about two of the places you can put your excess savings. One is into super, and there are some great tax benefits and long-term wealth creation benefits of doing that, adding extra contributions to your super, and comparing that to the benefits and disadvantages of putting that money into an investment property, which also come with some tax advantages, as well as some drawbacks as well. So one of the reasons investment properties are very popular is because you can leverage your money, which means you can actually invest more money than you actually have to buy that investment property. And in addition to that, there's the benefit of earning rent along the way, so you're earning income, and there is the tax benefits of negative gearing, which means you can potentially write off the difference between what you're earning and what you're spending on interest off your salary to get a tax benefit. So there's some of the benefits of an investment property. The disadvantages are that there's a big outlay to buy an investment property. It's not that liquid, so it's difficult to sell if you need the money quite quickly. And you can have problems with tenants and big costs of running and maintaining an investment property, as unfortunately a lot of people find out after they've run one for a little while. So although it can generate good income over your lifetime, there are lots of costs involved and it can be quite cumbersome to have to manage an investment property. So the other place you can think of putting your money if you have extra savings is making contributions to your super. Now, up to certain limits, you can make very tax efficient contributions to your super, and the benefit of money growing within super is that it's taxed at a lower rate. So typically within your super, any growth in your money is only taxed at 15% or potentially 10% for assets that you hold for a longer period, and income you're generating through dividends is also taxed at that lower rate. So you're benefiting from that compounding without as much tax, which can really grow your money faster over the long run. That's probably the biggest benefit of putting it in your super. The other is diversification. So an investment property, you may only be able to buy one or potentially two if you're lucky. With a super contribution, your money is spread across lots of different businesses and industries and asset classes, and so you're a lot better diversified. The drawbacks on the other side of super really I see as twofold. So the first one is that you're really locked in it until retirement. So you don't have the opportunity to take that money out earlier if you need it or you want it to buy another property or use it to go on a holiday. Once you've put it into super, you can't touch it until you retire. And that's a bit of a drawback for a lot of people who may want the optionality to be able to use that money earlier. The other is that super isn't a physical asset, so it's not tangible. You can't touch it, you can't feel it. And the third drawback from super is that compared to investing outside of super, that benefit of that tax advantaged structure really is not as big if you're holding assets for the long run, because even outside of super, there is the capital gains tax discount, which means that you're only paying capital gains tax on half of your capital gains. And so the benefit of super versus not super isn't as large over the long run, and actually it may be more appealing to have the optionality to use that money outside of super for a lot of people. So overall, I think that investment property can suit some people if you're happy with a bit more concentration risk in one asset. Don't mind the fact that it's a bit more high touch. You may need to maintain it and look after it, contribute to costs over time, but like the idea of having that leverage, which allows you to grow your money quicker. On the other hand, if you want to grow your super faster and have that diversification and don't mind you don't have access to that money for a while, adding extra contributions to your super can be a good strategy as well. I should say with all of this, this isn't financial advice that's personalized for you, and you should consider your personal circumstances, and if you need, see a financial advisor to get advice on which of those strategies is right for you.